Ian Capital does general commercial real estate capital advisory, really debt and equity placement across all property types, all parts of the capital stack, all over the country. I sit in Puerto Rico, and we have an office in Los Angeles as well. All right, Chad, you want to introduce yourself?
Good morning, everybody. Chad Carpenter. I'm CEO of Reven Captial. We're a private real estate investment firm. We're really focused on value investing and stressed investing. We invest in assets, companies, public securities, non-performing debt, and we'll invest in all asset classes. And I've been doing this for 28 years and been through 4 cycles, and it's always fun.
Great. Joseph?
Hi, my name is Joseph DeMatteo. I'm the President and Chief Executive Officer of JDM Capital in New York. Our focus is on pref, mezz, bridge, co-GP, and direct acquisition of hotels here in the U.S. and certain international locations. We're very active, but most of our stuff is that we're looking at is where we have more active operations in the investments that we're doing. So the things that we're focused on is where there's a direct operational capability for us to impact the business side as well as the real estate side of what's going on within the transactions. So thank you very much, and I appreciate FIA for all their support and help.
Great. Anna?
Hi, my name is Anna. I'm the founder of Analytics Miami. We provide independent long-term trend analysis on the market with the goal of bringing clarity by identifying prevailing momentum cycles and trends. I'm also the founder of Liquidity Solutions.org, which is private capital allocated towards various types of debt relief and acquisitions during this period of uncertainty.
Great. So I'm really excited for this conversation. It's a lot of things we could talk about. But I think one of the things that we were kind of discussing before the panel started, I think is really interesting and would set a good context for this discussion would be, Anna, would you mind giving just a brief rundown of this new normal that you're talking about?
Right. So what I was saying was it's important to put all of this within context, right? Deal specifics, markets, et cetera. It's all within the context of the broader world and the changes that are happening and the new normal, right? Normal is never what normal was. History has never gone backwards. It always goes forwards, right? There are kind of 2 constants in history, human nature and time, right? Human nature plays out over time, and we get cycles because human behavior herds and things always change. So we have to recognize that things will not go back to how they are. And we have to recognize what aspects of life and the markets COVID has accelerated, because everything resides within that context.
Right. So,
and that's a good thing. I mean that as a very, very positive thing, because history advances forward, right? Like my grandmother turned 98 5 days ago, and she was born in 1923 in Macedonia. They didn't have an indoor bathroom, and now we have video chat in our cell phone. That's why I wished her a happy birthday, right? So we have to embrace that change as a good thing, and gear our minds towards that and seeing where the flow is, right? Because the 20th century was pretty awesome unless you were in Hiroshima when the bomb was being dropped, right? So you want to align yourself to where these new feeder markets and where the money is flowing and put everything within that context.
Right. So given that context we've established, I'm going to go to Chad. Where do you see recovery happening quicker around the world? In what markets?
Well, hospitality in general, clearly the states that are opening versus the states that are not opening. So actually, we heard Florida was open. In fact, we were talking about, I just went down there last week, and it was very busy. Restaurants were busy, bars were busy, hotels were busy, and hotel rooms were very expensive. And I think they're getting, a lot of people are going to South Florida in particular because it's open where other places are not open. And so they're seeing that influx right now. So, but I think, I think once COVID's over, everybody's vaccinated or the pandemic is gone and people can freely travel, I think, all the other markets will open up. But as Anna mentioned, behavior with the Zoom and the cell phone, I was on a call with an investor in Singapore last night, and he's like, people are going to travel less for business. There's going to be less in-person conferences. I mean, even if you did, I would do 5 in-person conferences a year, and it's okay. So maybe we do 4, right? Instead of 5. That's a 20% reduction. So that's a significant impact to hospitality if that's 20% impact is the case. So
I think that there's a value proposition to some of the events, right? Because there's ones that you have that are nicety and ones that are necessity, in the industry. So if you looked at like retail and, the Vegas concept of you being able to see 15 people who are 5 blocks away from you, or going to Vegas and seeing, 50 of the people that you could see around the country in one location, I think there's an opportunity for that. I think that the newer events, the ones that aren't as classically aware, are going to have a tough time. New York is a great example of that. You used to have going back in the, 28, 30 years ago, in the industry, if you weren't at the Rebney dinner at the Hilton every year, you weren't going to get any business done. 80% of the world was focused on that Rebney dinner, and that changed already over the years. But it's a standard that if you're in your New York real estate, that you're generally there or at the, in and around the additional parties that go around that. So I think that there's ones that are going to be constants, but, the flow of the general business pieces of whether it's, offsites and trainings and things of that nature, I think that that's going to have a difficult time. And I think that anybody who's trying to be, newer, I think is going to have also a difficult time. Is MIPIM going to be, 15,000 people trying to get into 5,000 hotel rooms in the south of France? We'll see, right? But I think that there's a draw to the usual for, as you said, you'll cut out the 5th one, but you'll still go to the other 4.
Oh yeah, no, I agree. I love going to conferences and seeing those 50 people at once. It makes a lot of sense. And then also, Nate, you're saying, leisure travel, domestic leisure travel's up, right? Everybody wants to get out, and everybody was cooped up, and even me, I wanted to get out and, go get out to California and go to Florida. And I think that will continue. And I think, the Caribbean and Puerto Rico will benefit from that quite a bit. So, and then, drive by, obviously hotels will do well. People are getting back out. But what's interesting, is we're in the U.S. and I think at least our view is, with vaccines and the COVID is dissipating, and infection rates are going down dramatically in the U.S., which is fantastic. And we kind of feel like this is getting over, which is exciting. But foreigners, they're like, it's a problem, for global travel and global business travel. Like, it's a big issue in Asia and India, and it's COVID's, it's not over. And so we got to think about, how that affects the global travel demand and business demand too. It's not just here in the US. We're in the clear. We're not in the clear globally. So
definitely that's a concern even from the hotel side. Does the domestic traveler get fatigued? Back to your 4 and 5 kind of concept. Well, they're looking to get out of their house and they're trying to get away for a weekend or every other weekend. How long does that continue till they start to leave? It's kind of a little bit of Stockholm syndrome. You start to be able to just kind of fall into place of where you think that you're going to be. Well, this is what it is. This is life. And international travel opening up doesn't mean that you're going to be able to do anything when you get there. To your point, Chad, that's a really important thing. It's like people are like, oh, wait, international travel, people are going to be able to go anywhere. That's nice. You get off the plane and then you could be quarantined for 14 days. Yay.
exactly. Another thing I kind of think about is, inflation is a big topic right now. And then, inflation, price of commodities are going up, gas is going up, lumber's going up, certain food prices are going up. So, now, people have all this excess cash. For some people, if prices go up and then people have to spend more money on basics, maybe that's one less trip, right? So you got to think about that a little bit. So, for hotel demand and travel. So
yes, it sounds like what you're saying is that as inflation goes up, we might see a slowdown in this leisure recovery.
Well, just slightly. I mean, it's an affordability issue, right? So if you know people who have cash will go on vacation. If they can't afford it, they won't go, right? So it just kind of depends.
Right. I think that also goes back to the point of identifying your feeder markets. Who's your customer and what's the feeder market? Because one of the things that COVID has done, one of the things that's accelerated is the wealth gap, right? So while we have job losses being borne overwhelmingly by lower income earners, we have people with assets, financial assets, who have money. And those people are going to travel and spend money. And for instance, we're seeing that influx come into South Florida. And so if you can cater to that market, that trend has no signs of abating. So if that's your feeder market, you can offer a unique experience-driven product that's I don't think people want like the big, generic experience, right? So we're seeing this in Miami Beach. The highest occupancy rates outside the airport are on, 100 to 150 key, perhaps mid-sized oceanfront, because you can't replicate the ocean. And there are people who have money, clearly that segment is growing. So they're always going to seek that out. That's the feeder market there. And then perhaps also, as we're not going to go back to how we used to work, right? So as people are more mobile and moving around more, perhaps also the pandemic is going to force the hotel industry to be more like Airbnb, where you have larger units. So it's better than a condo hotel, which has that very high carry costs and all that stuff, where you're going to cater to the feeder market of people who are more mobile in the future as they work.
I think that one thing that's going to happen is that no one's focused on is also the changes in the job market, right? If you've been employed or have a job, you're in good shape. What's going to happen to all these new students that are rolling out, that have come out, graduated last May, this May, next May, you're going to have this kind of lost, stopgap. And I think that that's going to present an opportunity actually for the hospitality industry to maybe get different people that they normally didn't get.
Yep.
That because they're going to focus on travel and tourism as a focus, because it's one of the largest industries in general, but one that is, because of, let's call it, the handling of the unemployment benefits, has created, as as being an owner operator in Florida, lots of fun to try to get people to be able to work.
Yep.
And I think that that's going to pose an interesting opportunity when things start to shift. What kind of quality are you going to get? I think you might even get an uptick in quality as things start to shift. And there's young people that are out there that might be able to look into this industry that you might not have seen before. And fresh blood in this circumstance is, I think, always good. So that's what keeps the guest experience on a positive note. There's a good thing of same old, but it's also that fresh newness, that energy that you can't replace, and that smile that you see when you get a check-in. Not an iPad, but a smile.
Right. So given this, we're talking about people looking at experiences more. How are you guys viewing opportunities in ecotourism and those related properties?
So I'll just say one thing in regard to, we were involved with some projects that are outside the U.S. that were, from the ecotourism side. I think that there's, a general draw just from different, but I'll slice that to say that I think that one part that's growing is glamping. And the glamping segment is something that we've been perusing around and have been involved in bidding and looking at everything from these bubble tents that are near, the Grand Canyon, to outside the on the waterways of outside of in Illinois. So there's a desire to be in open spaces, which reflects back to a lot of the more national, especially for people who are going out to the suburbs, they want a backyard. So the idea is, I think it's tied to that same psychology, that they'll definitely, there's a demand for it. I think that people haven't communicated the experience well enough for people to feel like, well, really, I'm going to get a shovel and have to dig a ditch, or is there really, a cabin with a bathroom that I can use? So I think that that's the, how to get everyone vertically aligned. And that glamping concept is there. They're out in the open, they're in nature, they can go kayaking and fishing, disconnect. I think that's going to be part of the psychology that people are going to look to do. we're all so connected. We're so connected. Now this is like an appendage to every piece of life. And I think that people are going to look for those needs to literally say, when they say, I have limited or no access to email or phone, they're going to really mean it. So I think that there's definitely something in the glamping side to pay attention to.
Right.
Yeah.
That's
I
a cool,
wonder if,
especially, I was going to say, especially since people who are younger will have no recollection of a life without the cell phone. How interesting is that, right? No recollection of being disconnected or going out to play with your friends and being unreachable.
I'm not that young, and I'm not sure I have a recollection of how to operate with that one. So.
Exactly.
So I'm curious, on the glamping side, are you seeing any major flags starting to produce, different brands specifically around that, or is it really only in the boutique sector right now?
It's been in the boutique sector because it's highly seasonal in the locations that we've been seeing, and if you go and you have suddenly 500, tent sites, it's not getting the same experience. So they're not driven by the revenue concept. They're not going to go out there and you're going to make like, $25 million on a glamping site. It has to have certain things in order for it to be able to be. Now, mind you, if you go to some other places outside the U.S., there's experiences that are like that, whether it's in South America, that are segmented, away. We worked on a project many years ago in Central America, and it was in the middle of a rainforest. So, those types of experience, and those are like much higher end tours. So they're sold in tour packages. So what you can see is you're going to get your airfare, you're going to get your, ecotourism experience. And then there's agritourismo, we can't forget about too, that people are also attracted to. And they're going to have a fishing trip, and they're going to go fishing for 5 or 6 days and fly back to, the world. So I think that you're going to see a lot of, that's where you're going to see maybe the major brands be more attracted to kind of give you the short answer to your question.
Right.
Right. Those are, non-commoditized, experience-driven product. Right.
Right. So we have a question from the audience. So Rob is asking, how can developers or landowners better embrace hybrid produced events? So, say partial in person and partial virtual, given this new normal.
I think it's happening already. Yeah, the question is specifically, are they going to work, or how are they utilizing it? Nate, can you just qualify that for a second?
Yeah, I think he's just asking how developers or landowners that are as they're thinking about investments in new projects may the question was, how do they embrace? But I think you could ask that a couple different ways. One, how do you think about that from a design perspective, how you're structuring your programming and all of that? Like, how can you build either build or modify assets to be more conducive to both virtual and in-person events?
I'll say two things. One is, I think that it's a really great opportunity for smaller assets, which I think is the hottest segment. Even Anna made a reference to it before, in regard to the fact that I think that the hottest segment is under 200 keys. And I think that the smaller assets with smaller accommodations will be able to do more interesting things, where you've got, you create a limitation of like, wow, with 50 people in person, you charge X plus Y for. And then you've got the Zoom that'll be, Z to be able to attend. I think that that's going to be part of that parcel when you start to see that those in-person, hybrid things. Actually, they're great also to the fact that you don't have to be there for 5 days. You can go in and be there for 2 days. You can have it completely offline, and you can have an offline and online experience. But I think that trend is going to open up the opportunity where you're going to see less free-for-all Zoom calls and Zoom, things. You're going to start, they're going to see them speaking way more about costs in regard to joining these things. The information, it's kind of like, you're going to see things starting to get charged for. You're not going to have that, open access. And I think that you're going to have more, online chat rooms where you could break off. You're going to have more breakout sessions. People have been experimenting with them. They've been iffy, I think, at best, in regard to how to direct and what that means. But I think that it's definitely a programmatic opportunity for smaller hotels.
That's a good segue. So, Anna, can you talk about what you see as some of the positive effects of this whole pandemic on the hospitality industry? Like, how is the industry going to change in more positive ways?
Right. So just tying into continue what we're saying, I think that I think it's a good thing to have unique experience-driven product. And I think that as these hybrid models emerge for events and so forth, we'll actually get higher quality in-person interactions because people who aren't necessarily, don't have to be there, won't be there because they'll have a virtual alternative. They can get people to attend who actually are the value add and need to be there. So I think from an event perspective, that's a positive thing. I think it's a positive thing to offer experience-driven product. And I also think that the Airbnb model coming into hospitality is a good thing too, because the concept of mobility and people working from various locations is not going to go away. And the STR space is doing very well in South Florida in terms of occupancy right now. And as that influences hospitality, then hospitality can offer, larger units and things more conducive to the mobility of how people work. It's a good thing too.
I'm curious, you talk about this move to like an Airbnb type model for hospitality assets. Are you envisioning the same type of experience where it's automated check-in?
Yeah. Yeah, I do. Automatic check-in, more outdoor space, which places like Florida or Puerto Rico where you are conducive towards that. I think that's a trend that's going to stay, so 100%. And then people who are delivering new product now have that opportunity to gear it for the future, which is also why I think secondary cities are really well poised to benefit because they probably have smaller footprints of hospitality and office. And as sort of these pre-COVID, pre-internet epicenters dissipate, new cities can build new product that's more conducive to this future, which is, I think, going to further keep feeding them as things spread out to more multipolarity.
From our side, one thing to just segment is that we're definitely looking at a lot of transitional hospitality assets, which is in our world is where you've got part hotel and part rental.
Right.
Where you're going to have that segment, not a condo hotel specifically, but because we think that those are difficult. But from the side of where you're able to take a 500 key hotel and restructure it and restack it, we're focused on that segment. Looking at it and saying we're going to make 300 apartments and 200 hotel keys. So the people who are renting there and having that kind of experience to say I'm going to be there for 3 months, 6 months, or this is where I'm going to live, can have that kind of experience in a much more organized way. And I think that's one of the things we see as an opportunity as part of those challenges and changes to post-COVID.
So I think that's a really interesting deal structure. And so in that type of opportunity you just described, do you envision that the cap rate on the multifamily portion of it would be comparable with, other multifamily assets in the market that don't have the hospitality component?
So the way that we've been underwriting it has been looking at both the examination of the opportunity for ADR, and also looking at the rental markets. So there's a percentage differential that you're getting effectively as a premium for being in a hotel. So the idea is that we only utilize, and I'm answering your question from the top down, we look at the revenue side first. On the cap rate perspective, it's market and location and asset type driven. So I think that it's still going to be viewed in the market and the underwriters and the banks as a hotel asset, because I think that you can do well by keeping it within the opportunities for not having to beat up the zoning, where you can wind up into different problems. So making it an easy transition for redevelopment versus fighting the redevelopment. So I think that what'll happen is the banks will be much more comfortable because like, hey, wait a minute, you've got, instead of having 300 vacant hotel rooms, you effectively have turned them into, apartment quasi-furnished units. And now we can depend upon year-to-year leases with a 200 key hotel. We like that way better. So
I like that. That's great.
Yeah, I'm thinking you're taking a portion of a large asset, and since you're effectively changing the use, I would suspect that you would get some just fundamental value lift from that just by having the long-term rental income, which of course has additional stability versus the hospitality.
Well, you're de-risking the cash flow, right? You got apartment or multifamily is the lowest risk of all the, you know, commercial real estate investment asset classes, where hospitality is much higher risk due to the deal at least. I love that idea. That sounds fantastic, Joe.
Chad, I'll tell you the wiring instructions after.
I agree.
That sounds great.
I think that's very clever. Like, so you have one physical piece of real estate, but just by changing the use of a certain portion of it and putting in like a different, you know, asset class segment, you're going to get a lift from that, I would think. Now, I don't know that you can value that portion separately at a 4 cap versus say a 7 or 8 cap for a hotel, but you should get some compression, I think.
Now, if you're able to create a commercial condo component within the asset, where you can create condo A and condo B, you can do something in that regard, and we've looked at assets like that. So you would take floors, let's say 4 to 12, and that would be the hotel component, and then 13 to 30, and that would be the condo component for residential. Now, it creates a codependency like any other condo, but it de-risks the overall even operating expenses, which are generally higher. Right. And we've found in the discussions we've had with local municipalities that, hey, they're like, wait a minute, we're not losing any hot tax. That's kind of the key. So, okay, we'll let you do kitchens and we're going to get the hot tax, and we're really pretty good about that. You're really not, you're just adding certain things. Now, certain places are very difficult. There's weird things like in the city of Los Angeles. They've got this thing that they don't allow kitchens into extended stay or anything in that regard. So you've got a weirdness of how they've designed stuff in the assets we've looked at downtown LA, which this would be a phenomenal component.
Yeah,
but that's a good example of a municipality that's got a wall against that business plan. But you find other ones that are more welcoming.
So are you seeing other general, I know sponsors personally that are pursuing strategies of not the combined structure we were just talking about, but of acquiring existing hospitality assets and fully converting it to some type of multifamily or affordable housing.
Yeah, I think that sometimes if you looked at that, you'd also see how expensive it could be. You turn around and you say, listen, I'm only putting in, Ben, I'm using an oversimplified 500 key example that now you're taking 300 and making them into, you might get 150 at the end of the day. You're combining units, you're reducing costs, and you're also reducing doors. But at the same time, I'm only putting kitchens in and, into those segments, and I'm leaving the rest alone. So you're creating a higher revenue opportunity. You're de-risking a hotel asset. And the third thing that you're doing is you're reducing your actual capital costs by only doing a portion of that. So now you've got the stability of multifamily with the upside when things are great in the hotel industry and maximizing that. So you're not locked into any of those components.
I would argue, Joe, that, if you've got, real annual rent leases like an apartment rent, there's no reason why you wouldn't get a lower cap rate on that.
Possible. But you know what? That the banks aren't going to argue differently.
I mean, the buyers, I think buyers would pay for it, irrespective.
Yes.
I think, Joseph, what you're saying with regards, if you can condo out a separate portion so that specifically for the long-term rentals, so they literally are separate pieces of real estate, but you're operating them in a complementary fashion. I think that's where you get your higher valuation.
Yeah, we looked at our projects that we're looking at in Washington, D.C. have been like that, because there's huge demand for that marketplace, and then from an international user perspective.
Urban cities have been doing this, multi-use, right? Hotel, office, condo, or apartment. There's nothing new there. So high rise.
They're used to seeing it, but they're not used to changes in the taxation that they're suddenly going to use. So it is an underlying zoning challenge,
right,
that you could be able to do. So you're creating this new condo that could be, you want to have also, separate egresses. There's a lot of other things that fly into it, but them letting go in that hot tax, even though the place is half vacant, the municipalities don't think like us operators and owners. So they got a little bit of a wall to get past.
No, we've seen a lot of foreclosed and kind of bankrupt hotels that were tracking that had negative EBITDA in 2019 just due to oversupply issues or lack of demand in certain markets. And those hotels would be an ideal candidate for this hybrid, multifamily hotel concept, because they still need some hotels in certain markets. So that's fantastic.
Chad, what kind of markets would be examples of that?
Well, we looked at some stuff in Connecticut. There was a hotel up there, and the business demand just dropped off the cliff, and it literally had negative EBITDA for 2018, 2019, and then it was caught up in a bankruptcy on these hotels. And we looked at another deal in Dallas. It was actually auctioned, and over 400 keys, and the thing had negative EBITDA in 2019, and you needed about 45,000 a key to in PIP to rebrand it, and you don't make any money. It doesn't work. And so we're thinking multifamily, senior living. There's too much hotel supply, but on a hybrid deal, that's kind of interesting. So even in Houston, Houston's got a ton of
we
press.
just were very aggressive in a deal there that's quite large, and it was ideal for that use. I'm trying not to be too specific, but it's no longer on the market because it couldn't reach resale values. Larger hotels have massive overhang for operations. So if you buy that today, you're picking up a lot of negative costs day one, even if you're not doing the redevelopment. Just
It's
even
expensive.
to hold it. Oh yeah.
Yeah.
Much more than people do, and the brand standards that people don't understand.
Yeah.
You go
CapEx,
there and it's.
I've actually been quite shocked on some of the pricing I've seen and some of the bidding on some of the bankruptcy deals, and after the price they paid with the carry cost, reopening costs, CapEx, ramp up, maybe single digit returns. For that risk, I don't know. There's just a lot of capital out there looking for deals, and there weren't a lot of distressed deals done in 2020 because everybody's kind of pushing them out, and people are like forcing deals, I think, a little bit. So
I think that you've got a compression in availability of product.
Mm-hmm.
So once PPP runs out for a lot of assets, you're going to see a lot of inflow of new deals and so forth. But the market for major markets, some stuff is kind of thin. And now you've got not only domestic, you've got foreign capital competing for these assets because they'd rather be in the US because we're going to have a higher bounce rate or more rapid bounce rate back to recovery than, most places in the world.
Yeah. With fixed income being so low that people are, looking for yield anywhere they can. And I think they're taking on a lot of risk for lower yields.
Well, the only thing I would counter that is that I agree with you, except that what's coming down the pike in inflation is where people are also looking. So you'll pay more per key because the replacement value is moving like this. You're chasing that replacement value right behind you. That let's say it's 250 a key, and you're building it for $4. That's going to be 500.
Yeah, but when you do the PIP, your costs go up too, right? So
Totally.
So your base is going up quite a bit, and the expenses. It's funny that I've operated all sorts of real estate, and it just amazes me. Expenses never go down; they always go up.
Never.
Expenses and CapEx always goes up. It's like it's out of control. So you really have to be careful on the underwriting. When you on any investment, right? Any asset class. So.
I'll say I think that the dirty little secret, so to speak, in underwriting is the fact that the unemployment circumstances have forced operators to have to pay more money, especially in a market like a Florida, because of the restriction of labor that's in the marketplace by force of that. So it's kind of interesting that at the municipal level, it is forcing higher rates of per hour than you normally would see because of the need for and the competition for labor.
Yeah, everything's more expensive.
No, 1,000%. People can't find employees. I don't go to malls very often, but I was in a mall yesterday or 2 days ago, and they had hiring starting at $15 an hour signs everywhere, and they can't get employees. Same in hospitality and restaurants, they just can't hire people, even though occupancy here is up. But it's this funny thing where we have like inflation fears today sitting on top of, what's been like a global chase for yield that's been fueled by very, very low interest rates and negative yielding sovereign debt for the past 10 years, because the last crisis never really unwound. It was all piled up. So now we have those two things happening concurrently. It's very interesting. Like when you see charts going vertical, it's never a graceful exit, right? And what's the paradigm shift? Like, I don't know, but we have these vertical charts of debt accumulated the ECB, our Federal Reserve, all that stuff. And what's the exit from that? I don't know. And at the same time, we have labor shortages and inflation concerns.
Here's the other side of it. You'll know when this is starting to all end when you start to see the bankruptcies.
Yeah.
That's the beginning. That end signals truly the beginning of the next market, next cycle. So that's when everything's falling out and it's now panning its way out. And it's kind of like, it's the hurt before the heal.
Yeah.
On that note, we talked a little bit on the pre-call about, 15% of all CMBS loans are still in default.
Right.
And, the can's been kicked down the road and, owners are out of cash and, I don't know if there's rescue capital for these particular owners.
Chad, it's an excellent point, but the 15% is not forgetting the other 15% that are on 6-month extensions and they've been reworked.
Yeah.
So
they're not in default because they gave them extension again. So there's no question.
It's a good country and western song. It's like trying to put a Band-Aid on a bullet hole.
Yeah, no, it's tough. I mean, if even if you have positive EBITDA and you can't carry your debt service, and then you got a brand PIP coming up, you're done.
Yeah.
Yeah, we talked a little bit about this yesterday. We were calling these over-leveraged assets basically zombie hotels, right? So when do you guys expect this to really come to a head, and what exactly does that look like?
I'd say 6 to 9. Again, disclaimer. But I think it's going to happen in the 6 to 9 months. Once you've had the PPP monies run out, once the brands have gone back to full standards, some of them relax the standards to allow the operators to be able to stay in business. And they're right now, there's no in-person, they're not coming to check to see, is this a, XYZ Tao? Does it say Sheraton? Does it say Marriott? Does it say anything like that? It's kind of like a self-reporting to a certain extent in regard to how you're doing this. So I think that once that starts to shift and change, you're going to see that shift with that, and with the PPP running out and those full-blown brand standards being required. 6 to 9 months is probably when I would say that hit is going to happen.
And what do you think that results in? Is that bankruptcies?
Yeah.
So
I think it's going to be an increase in bankruptcies probably next year. You'll start to see more of it this time next year.
And foreclosures. People part investors aren't going to put more money in when they're upside down. So
you think these assets are leveraged to the point that they couldn't get out of it just through a sale?
Some of them can. Some of them can. Some of them will. Some of them are mitigating risk. But I think that there's going to be value is such a blurred line. Chad said it earlier in regard to where people are paying for things. So I think that it's very difficult for appraisers to appraise. And I think that there's a big value proposition of people looking at things that make it on the buy, which is okay. I mean, that's all right. You're looking at it and you have to have some vision if you're in this industry, other than if you're doing Motel 8s for a living, and that's nothing wrong with that, but it doesn't take a lot of imagination.
Yep.
There's also quite a few public companies, hotels and other asset classes that really everybody hit the credit lines, right? So
big time, and bond issuances. Some of them did bond issuances that you can read it in the public market. I think it was it's public information, so I guess I could say it. Like Chesapeake is an example.
Yeah.
The guys went out for $200 million, and it wasn't to invest into a hotel; it was invest into operations.
What's interesting? I've been watching all these public companies, and the enterprise values have all kind of come back to what they were 2019 levels, but the equity market cap is still down because everybody levered up. They either levered up or they got preferred equity. But all these stocks, most of them are pretty maxed out. I wouldn't be buying a lot of these public securities if the enterprise value is equal or greater than to what it was at the end of 2000.
You still may see consolidation in that area. I think that there's going to be another wave of that.
Yeah.
And if you look at what happened with the operators like the Ames Bridge and so on, you had operators vertically integrating assets.
Mm-hmm.
As franchises like Hilton dispersed of the hard assets.
Yeah.
So what happens next? That's an interesting thing.
No question. I mean, a lot of the guys are over leveraged, and their only resort is a down round or merge or sell, right? And they're not going to want to do a down round. So it's gonna be interesting.
It doesn't make sense for them as a company. It's better off that they would be able to merge and give the shareholders a chance at life again, so to speak, as long as the basis trade properly in cash and it's a properly balanced cash and stock deal to be able to kind of bring them out the other side. But I think that there's going to be more consolidation in the industry from the public sector. And not, in a lot of real estate assets. I don't even think hospitality is neutral to it. You may see it in the office REITs. You see it already in the retail side.
Yeah, no, we're big office buyers in the past, and I think office is going to be in a rough ride for a couple of years. So,
So now,
same issues. Zoom, flex office, same effect. Change in behavior, work behavior.
So each of you have some, capital you're looking to deploy. So I think maybe it'd be beneficial just to kind of quickly go over what types of deals and deal criteria you're looking for. And maybe if you have, if you can just at a very high level have an active deal or recent one, kind of like Joseph, you're just describing, that you could talk about. So Chad, maybe if you don't mind.
We're looking for larger portfolios right now, 300 million and up. We've got institutional capital coming out of Asia, and we're looking for big, just kind of portfolios, companies, public to private opportunities, and we like all asset classes at the right price. So if somebody's got some larger opportunities with upside, we do want upside, value and upside. So happy to look at that. And then on the balance sheet, we are, doing one-off deals, offering on office and hotels, in-house. So, we're only really looking at bankruptcies and foreclosures for those assets and non-performing debt.
Gotcha. And are you acquiring directly? Are you coming in as a joint venture partner with another sponsor?
Both. We're kind of hybrid. We'll buy it direct, or we'll provide equity if the deal makes sense.
Gotcha. Okay. Anna, you want to speak to that as well?
Yeah, sure. So with Liquidity Solutions, we basically have institutional-sized private capital that's very, very nimble and ready to deploy. And we're kind of looking for assets that fit the thesis, that are within markets and along the curve of what I think is going to recover, but that today are imperiled in some way. So need an exit, but we're happy to have carry costs to acquire them now with the vision that they're aligned to recover, just they're in trouble now. So we like hospitality, but open to other things.
Gotcha. And in hospitality, is there specific, flags or asset types you're looking at? Is really kind of all the above?
All of the above. 100. I mean, nothing smaller than 100 keys, but locations that I think are going to be sort of resilient or value add moving forward.
Gotcha.
From our side, it's highly selective, one-off these days. I would say that it doesn't matter boutique or franchised. We generally wouldn't go below 90 or 75 keys unless it's for a specialty asset. And I think we're top side at 250, 275. That would be on any hotel aspect of it. And the residential component that goes along with that could be larger. But that's, we're looking in that more specific market segment. We're not looking for really a portfolio transaction unless it was something super special. We would look at it a little bit further. And I think key and location drives us more than anything to be able to justify where we want to be from a basis perspective.
Gotcha. So one thing I want to make sure we touch on is kind of the attitude of the capital markets with regards to hospitality deals. So what are you guys seeing right now in the availability of, both debt and equity, and that could be bridge debt, sub debt, construction debt, and then, also on the equity side?
We talk to a lot of investors and for raising capital for hospitality, and most of them are pretty scared. They don't want to do it. on the equity side. Even though I think, it's, at the right price, now is when you want to buy a foreclosed hotel or bankrupt hotel, depending if the price is right for the risk, right? But I would say the majority of the investors are, very concerned about the risk of hospitality going forward.
Yeah, I would agree. I think that people are having a difficult time with sort of the clarity of what's happening with the future and their vision, right? There's going to be this whole cascading effects of the PPP loans, all these things. Like none of this is fully played out yet, and there's still uncertainty, and new habits are still forming while the debt situation still hasn't resolved itself. So, yeah, there's a lot of uncertainty and fear. Some people have a thesis, some people don't, but I don't think the picture has become clear for most people yet in terms of how to price and perceive risk.
All right.
From our side, I would just say that it's a very low leverage deals that that are kind of accomplished. Everyone's nervous. You get everybody from saying yes, we'll lend 35% LTV, to they're screaming down the hallway away from you, or the third one is that they're the debt funds are the ones that are active, and they're the ones that are looking versus the traditional banks.
Yeah, I would say we're seeing the same, although it does feel like things are loosening to a certain extent. So, for example, we started working on a rehab loan for a boutique hotel in a secondary market last fall, and really weren't getting a lot of traction. Just in the last, I'd say 2 weeks, we've gotten we have 2 term sheets in hand, and we're looking at potential terms from some other lenders. So that's a real, very recent kind of sea change on that front. So on the deals that you are looking at, are there specific return metrics that you're underwriting to? Like, say, for example, what would be, say, a minimum yield on cost on anything you're looking at?
Well, we're underwriting to a minimum net 20% IRR to investors. I mean, the classic, opportunistic return threshold for the risk, right? And it's really hard to get those deals right now. People are bidding deals up. We bid on a huge portfolio, and someone paid really double what we offered, literally double. And that was a wake up call, like, wow, so. But
what that entity that bid twice as much as you, what type of investor they were? Were they a foreign capital source?
No, they were domestic distressed investor. They're sitting on so much capital that they didn't deploy last year. I think they felt they needed to do a deal, and otherwise the fund, all these funds, you got to return the money if you don't do a deal, right? And then you lose your fees. I'm not saying they're doing it for the fees, but I certainly wouldn't have paid that price. So.
So, Joseph, you had mentioned earlier seeing foreign capital coming into the market. I'm just curious, are there certain parts of the world or certain countries where you're seeing that migration coming out of?
I think the interest is, I would say, from the European side. And I think that I think it's a recovery psychology that they have, that they feel that their market may be longer and stable over a period of time. So they're saying, well, we're not going to recover as quickly, but we'll have a more stable viewpoint in a longer period of time, versus where I think the US, I think there's some concern about longer periods of time. And I think that that's one of the things that we're seeing, is that you got to be patient in these deals. I think it's very difficult to make a 2 to 3 year decision in the hospitality sector today. I think you have to have a 5 to 8, 5 to 10 year kind of mentality. Otherwise, go have a cup of tea. So, I just don't think it aligns well. But Europeans traditionally have, let's say, a little bit more longer term thinking. And I think that, for an availability of shorter term opportunity that in the recovery, so they can feel better about it in the near term, is where they're looking at us.
I'm curious for anyone, are you seeing any opportunities coming out of this that you just would not have expected when it all started?
Yeah, I mean, I would have never thought that there could be a permanent decrease in demand for hospitality and office really, due to technology and behavior, travel behavior and using the Zoom. I never saw that coming. So that's really interesting. I mean, we all saw how e-commerce affected retail over time, right? We were talking yesterday. I was talking to my wife. We were talking about Blockbuster video. Or a Blockbuster video got blown out by technology. Netflix and Netflix offered a big number and they turned them down. They regretted that one. So Netflix became the winner. So it's just technology is a real disruptor for real estate, for bricks and mortar, and we've got to keep our eyes open on that one too.
We had talked about the rising labor cost and how that's going to affect your underwriting. But I'm curious, do you think that with advancements in technology, that's going to counterbalance that rise? Like maybe the total number of employees needed per asset goes down or the efficiency goes up?
I still think that people are gonna, not want the rubber crocodile. I think that there's a human interaction to the element. The concept of hospitality is the fact that there's a connection to the brand, the person, the experience. Looking at someone's eyes when they're checking you in and smiling at you and welcoming you, is just can't be replicated on an iPad. I think that there's going to be more craving for human interaction, not less, I think, at the end of the day.
I just envision going to Hawaii when they greet you, with flowers. How's that going to work without the person there? I totally agree.
Maybe for lower end, less expensive product. Maybe that's where it's going to be, like the drive-in, the drive-up hotels, things like that with catwalks and things. I think that's probably where that, because you're not paying for it. You're trying to get the cheapest price, so you're not gonna care. So maybe there, and then even like you talk about percentages, like even like self-checkouts, self-check-ins and cheaper hospitality products, even a 5 or 10% difference is huge across the labor pool.
Exactly.
Ramifications. And I mean, and now we're getting, labor shortages plus automation. Long-term is going to be more and more of a factor, AI, all that stuff, while we've sort of introduced this concept of a UBI, which I don't think is going away.
So we're coming up on close to the end of our time here, but I do want to wrap up by asking each of you just to briefly describe, what do you think the industry looks like 10 years from now, given everything that we've discussed?
I think it's going to be robust. I mean, I think everything comes back. People love to travel. I mean, think of you're going through your journey of life. Traveling memories are amazing. People want to get out and travel and stay in nice hotels. Great memories. So I think it's going to be fantastic 10 years out. And I think as demand decreases, even if there's behavioral demand decrease, construction will slow down, right? And eventually the stuff flows back in. And then some units will, convert to some multifamily, so supply will decrease. So it all over time, I think it fills back up and occupancies come back and hotels will be very strong. So
I agree 1,000,000%. I think it's going to look great. I think we're going to have very cool, unique, experience-driven product, much of which maybe we can't even envision right now. I think it's going to, change breeds innovation. And good things happen from change. That's when people's creative juices start going. So I think in 10 years time, we're going to see great, unique product that we probably can't even think of now. Like, look, the cell phone didn't exist. It was magic 20, 30 years ago, right? So we don't know. Great things keep happening. I agree with what Chad was saying. The need to travel, it's human nature. People love to travel. So that's not going to go away. So it's going to be a question of aligning cool product in the flow of feeder markets and money, which there always will be. So I think it's going to be more multipolar. I think more new destinations, secondary series cities and so forth are going to prosper, and then we're going to get cool new product in those locations. So I'm very optimistic on it. Human nature always moves forward.
We just want to make sure we pay a price where we can actually make, positive cash flow after debt service.
So yeah, I think like we've had this global chase for yield because interest rates have been so low forever, right? That's kind of the environment that we're in now, and now with their inflation fears on top of it. So that's not going to last forever. I don't know what the exit from that is, but
yeah, don't like I caution people, don't go pay a 3 cap for multifamily based on your low leverage. because interest rates could go up, and then
Right,
you're in big trouble.
not good, like they will, it's inevitable. We don't know exactly when, no one has a crystal ball, but everything moves in a cycle. Like it always does. That's like history moves in cycles. We can't say exactly when, but interest rates are not going to stay where they are forever. I mean, everything the Federal Reserve has done has been to try to, stop a crash in debt and keep interest rates where they are, but that can't go on forever. So.
Right. All right, Joseph, we'll wrap with you on what you think the industry looks like 10 years.
I think that bigger is not better. I think that it's smaller. I think costs will be higher, and we could be in a world where we're paying for hotel rooms with Doge and Bitcoin, and that's part of the future of what could happen in regard to what it is. I think that will change to a trading mechanism that exists, potentially. And I think that the authenticity, like I always like to use the concept of the rubber crocodile, right? I think that people don't want to see the rubber crocodile. I think that they want to have something that's very unique and experiential. And I think that the repeat customer is not going to be as repeat as it was before. And that's why smaller is going to be better. People are going to want to, I think, move around, see more things. That's a part of the change of what's happened today, that it's not going to be, oh, I'm going to go to Florida every year. It's going to be, oh, I went to Florida. Next year, I'm going to go to Grand Canyon. The following year, I'm going to go here. I'm going to go to Puerto Rico. I'm going to see one side of Puerto Rico. Then I'm going to go to the other side. I think that that's going to be part of the mentality. It's a little bit of a tribe mentality. I think is going to start from family side, and these family times are going to be much more, in the future, similar to that.
All right, well, guys, appreciate it. I think we're coming right up to the end of the hour here. Again, thank you for your time. That was a really interesting discussion.
Thank you so much. Appreciate everybody.
Great job, everybody.
Thanks.
Hey, thank you.
Have a great day.
Thank you very much for doing this today. We appreciate all of you. You did a fantastic job, and we're gonna cover this topic. It's obviously a hot topic today. So thank you all. And